My name is Stefan. I'm a financial expert, a long-term investor, and a resident of the United States of America. For over a decade, I've spent my life studying how money really works in high-income economies like the US, Canada, the UK, and Australia, countries where the tax system is not designed to punish success, but to reward those who understand the rules. And today I'm going to show you exactly how I legally pay less tax every single year, without hiding money, without offshore accounts, and without doing anything shady. Because here's the truth most people never realize. In high RPM countries, taxes are not just an obligation, they are a strategy. If you earn income in dollars, pounds, or Canadian currency and you're paying more tax every year, without questioning it, then you are voluntarily giving up your future wealth. The wealthy don't do that. Business owners don't do that. Investors don't do that. They follow a completely different playbook. And once you see it, you can never unsee it. Let me be very clear from the start. This is not about tax evasion. This is about tax optimization, which is fully legal, fully documented, and quiet, used by high earners across the United States and other developed economies. Governments in these countries intentionally create tax incentives to stimulate business activity, investment, and economic growth. And if you align your financial life with those incentives, the system works for you instead of against you. Most people believe taxes are fixed, that if you earn more, you automatically pay more. That belief is what keeps people stuck. In reality, what matters is how you earn, how you structure your income, and how you classify your expenses. Two people can earn the same amount of money in the US, and one can legally pay tens of thousands of dollars less in taxes, simply because they understand how the system is designed. Here's the hook that usually shocks people in countries like the United States and Canada. The tax code is thousands of pages long, and almost none of it exists to help employees. It exists to reward economic behavior, starting businesses, investing capital, creating cash flow, and taking calculated financial risk. If your income comes only from a salary, you are taxed first and allowed to spend what's left. But if your income is structured through business or investments, you are allowed to deduct expenses first and pay tax on what remains. That single difference changes everything. That's why two households with the same income can live completely different financial lives. One struggles, the other compounds wealth quietly in the background. Now let me tell you why this matters so much in high RPM regions. Advertisers, banks, credit card company, insurance firms, and investment platforms all compete aggressively for audiences in the US, UK, Canada, and Australia because these are countries with high purchasing power and high lifetime customer value. And the same principle applies to you as an individual. When you understand how taxes, cash flow, and incentives work in these economies, your money becomes more efficient. You stop thinking in terms of gross income and start thinking in terms of after-tax wealth. You stop asking, how much do I make? And start asking, how much do I keep? That mindset shift alone can be worth more than a pay raise. In this video, I'm not going to overwhelm you with complex legal jargon or obscure loopholes. Instead, I'm going to walk you through the core principles that high earners and financially literate individuals use every year to reduce their tax burden legally. We'll talk about why business structures matter, why depreciation is one of the most powerful tools in the tax code, how financing decisions can reduce taxable income, and why governments actively encourage certain types of spending. This isn't theory. This is how the system actually works in real life for people earning insane wrong currencies. And once you understand it, you'll realize that paying less tax isn't about being lucky. It's about being intentional. Most people never learn this because schools don't teach it, employers don't explain it, and the system doesn't advertise it loudly. But the information has always been there, quietly benefiting those who look for it. And if you live in or earn from high-income ions like the United States, this knowledge is not optional. It's essential. Because every year you overpay in taxes is a year you delay financial independence. And the sooner you understand that, the sooner you start playing the game by a completely different set of rules. Now that you understand why taxes can be optimized instead of feared, let's get into the practical strategies that I use every year to legally minimize my tax liability, and why these same strategies can work for anyone earning in high RPM regions like the United States, Canada, the United Kingdom, and Australia. The first principle is structuring your income through legal business entities, whether it's an LLC, S corporation, or a sole proprietorship, depending on your jurisdiction. Here's how it works. WHN, you earn income as an individual employee. Every dollar you make is immediately taxable at your marginal rate. In the United States, for example, high-income earners can face federal tax rates up to 37%, plus state taxes in states like California, New York, or Massachusetts. That's nearly half of your hard-earned money gone before you even consider living expenses. But when the same income flow through a business entity, you can categorize certain expenditures as ordinary and necessary business expenses, which are fully deductible against your revenue. These include items like home office expenses, professional software subscriptions, internet and phone bills, vehicle costs for business use, travel for meetings, and even certain meals when properly documented. In Canada, similar rules exist for incorporated professionals, where legitimate business expenses reduce taxable income and allow you to retain far more of your earnings without breaking any laws. This is why the wealthy always talk about deductions, depreciation, and tax credits. They are not tricks. They are legal structures built into the system to reward economic activity and investment. The second major strategy revolves around depreciation and capital expenses, which is one of the most underappreciated, yet incredibly powerful tools in financial planning. In the United States, for instance, Section 179 allows business owners to immediately deduct the cost of qualifying assets, like vehicles, computers, or equipment, in the year they are purchased rather than spreading the deduction over several years. That means if you buy a business use vehicle like a Tesla Model 3 or even computers for your home office, a large portion of that purchase can reduce your taxable income for the same year. High-income earners in the UK use similar mechanisms like capital allowances to write off machinery, tools, or even energy-efficient assets, thereby reducing their effective tax rate significantly. In Australia, accelerated depreciation rules for small businesses allow owners to immediately write off eligible assets up to certain thresholds, which translates directly into more cash in your pocket. It's worth emphasizing these strategies are not reserved for billionaires. They are designed for anyone running a legitimate business, earning side income, or investing in assets that generate revenue. Yet the majority of salaried individuals never utilize them because they simply don't know these rules exist. And here's the interesting part. Combining these deductions strategically with your income from investments or side businesses can reduce your effective tax rate by tens of percentage points in your first year alone. That's not a minor benefit, that's transformative. Next, let's talk about tax credits, which are even more powerful than deductions because they reduce your tax liability dollar for dollar. In high RPM countries, governments offer credits to incentivize certain behaviors, and this is where knowledge literally turns into cash. For example, in the United States, there are federal tax credits for electric vehicles, renewable energy installations, and education-related expenses. The 5% tax credit alone, which I personally leveraged when buying a Tesla, can be several $1,000s per vehicle, directly reducing what you owe the IRS. Similarly, the Canada government offers credits for energy-efficient home renovations, charitable contributions, and tuition fees, each of which lowers your tax bill in a completely legal manner. In the UK, there are R&D tax credits and other incentives for small businesses that engage in innovation. High-income investors across these countries often strategically time their investments and purchases to maximize eligibility for these credits, which is why the wealthy often have a disproportionate advantage in retaining cash flow compared to the average taxpayer. The key is awareness, knowing which credits exist, how to qualify, and how to combine them with deductions and business structures is what separates ordinary earners from financially intelligent ones. Another core pillar is financing and smart debt strategy, which is often counterintuitive to the general public but extremely effective in high RPM economies. Many people think borrowing money is bad, but when structured correctly, debt can reduce your taxable income and increase your investable capital. For instance, financing a business vehicle, equipment, or even real estate allows you to deduct interest payments from your taxable income while simultaneously preserving cash for other investments. In Canada, mortgage interest on rental properties is deductible, and in the United States, interest on business loans is fully deductible. Investors in the UK use buy-to-let mortgages similarly to generate positive cash flow and claim interest deductions. The financial logic is simple. Instead of depleting cash reserves to pay for assets up front, you leverage debt in a legal and tax-efficient way, reducing current taxable income and increasing long-term wealth. This strategy, when combined with depreciation, tax credits, and business deductions, allows high income earners to legally pay thousands less in taxes every year, while ordinary employees continue paying the full marginal rate without thinking twice. Finally, I want to highlight retirement contributions and tax advantage accounts, which are often overlooked by the general population but heavily utilized by financially savvy individuals in high-income countries. In the United States, 401ks, IRAs, and self-employed SEP IRAs allow you to defer taxes on income now while growing wealth for the future, reducing current taxable income. In Canada, RRSP contributions achieve the same result. In Australia, superannuation contributions can reduce your taxable income while simultaneously preparing you for retirement. These vehicles are extremely effective because they provide both immediate tax relief and long-term wealth accumulation, creating a double benefit that most average earners never fully exploit. The combination of these strategies, structured business income, depreciation, tax credits, smart financing, and retirement contributions, is what allows high-income individuals to legally pay far less tax every year. And when you truly understand and implement these principles in high RPM economies, your financial life changes entirely. What feels impossible for an average taxpayer becomes a strategic advantage that compounds over decades, generating wealth that grows faster than income alone could ever achieve. Before we dive deeper into the most advanced strategies that can transform your financial life, I want to take a moment and ask you to subscribe to this channel if you have and already. The reason is simple. In the next few minutes, I'm going to reveal insights that most people don't discover until decades into their careers. And if you miss this knowledge, you're essentially leaving thousands, sometimes tens of thousands of dollars on the table every single year. By subscribing, you're ensuring that you'll have ongoing access to strategies specifically designed for individuals in high RPM countries like the United States, Canada, the UK, and Australia, where earning potential is high, but taxes can quickly eat away at your wealth if you aren't careful. Now, let's continue and get into strategies that go far beyond basic deductions, tax credits, and business expenses into a realm where financial intelligence really separates ordinary earners from the financier elite. One of the most powerful tools used by high-income earners in these regions is income timing and strategic expense planning. This involves carefully deciding when you recognize income, when you make large purchases, and when you pay certain expenses to maximize deductions in the year they have the greatest tax impact. For example, if you anticipate earning more this year than the next, it might make sense to accelerate deductible expenses or defer income strategically so your effective tax rate remains lower. In countries like the United States, this could mean prepaying business insurance, licensing fees, or interest payments before year-end to create maximum deductions. In Canada, business owners might time equipment purchases or charitable contributions to optimize RRSP deductions or available credits. Similarly, in Australia, small businesses can plan vehicle purchases and professional expenses to align with financial year cutoffs, directly reducing taxable income. The key takeaway here is that timing is as important as the deduction itself. High RPM economies reward those who are proactive with their planning, and those who wait passively often overpay taxes without even realizing it. Another advanced technique revolves around leveraging multiple legal entities for income segregation and asset protection. In the United States, this might involve creating separate LLCs or corporations for different streams of income. One for consulting, one for investments, one for online businesses. Each entity can take advantage of specific deductions, depreciation schedule, and tax treatments, effectively compartmentalizing profits in a way that minimizes taxes legally. In Canada, similar structures exist, where incorporated businesses can claim deductions for operating costs, vehicle expenses, and even certain home office usage, while protecting personal assets from liability. In the UK, high net worth individuals often utilize holding companies or partnerships to allocate income and claim available reliefs such as capital gains exemptions or enterprise investment schemes. In Australia, asset protection structures combined with small business concessions allow for the same principle, Income is strategically separated and taxed at the lowest effective rate possible. By understanding and implementing these structures correctly, high-income earners legally read see their tax liability, preserve more wealth, and create a clear roadmap for continued financial growth. Next, let's discuss investment-specific strategies, which are incredibly high yield for individuals in developed, high RPM economies. Investments, whether in stocks, real estate, or alternative assets, are not only a tool for growing wealth, but also a vehicle for legally deferring taxes and narrating tax-advantaged income. In the United States, long-term capital gains are taxed at a lower rate than ordinary income, meaning that by holding assets for the appropriate duration, investors pay significantly less tax than they would on a salary. Canadian investors can benefit from the lifetime capital gains exemption on qualifying small business shares, while UK investors may use the NTERP. RISE investment scheme or seed enterprise investment scheme to reduce taxable income. Australian investors utilize capital gains tax discounts and superannuation contributions to maximize tax efficiency. High-income earners across these regions strategically combine depreciation, deductions, and timing with investment income, creating a powerful synergy where every dollar earned is maximized. The secret is knowing which rules exist, when to apply them, and how to structure your financial life so that all these mechanisms work together rather than in isolation. Finally, one of the most overlooked yet crucial strategies is strategic use of retirement accounts and tax-deferred savings vehicles, which are designed not only to prepare you for the future, but also to minimize current tax exposure. In the United States, contributions to a 401k, SEP IRA, or traditional IRA reduce taxable income immediately while simultaneously growing wealth over time. In Canada, RRSPs achieve the same goal, and in Australia, contributions to superannuation funds create similar tax-advantaged growth. High RPM countries reward individuals who use these vehicles effectively, allowing them to defer taxes. Our investments tax-free and withdraw strategically in retirement when their income and tax rate might be lower. This is why financial experts consistently emphasize starting early. The longer your money grows in tax-advantaged accounts, the greater the compounding effect, which far outweighs ordinary savings or short-term investments. Combining retirement contributions with deductions, credits, appreciation, and strategic income timing forms the backbone of a legal, high-efficiency financial strategy that wealthy individuals rely on year after year. And remember, all of this is fully compliant with the law, fully transparent, and designed to maximize your financial potential in high RPM economies. Now, let's take everything we've discussed and put it into real-world context, because why alone won't transform your financial life. One of the most practical examples of how high-income earners in high RPM countries like the United States, Canada, the UK, and Australia reduce their effective costs and taxes is through strategic purchases of high-value assets, particularly vehicles, equipment, and technology, that can be utilized for business purposes. For instance, imagine purchasing a luxury or high-tech vehicle, such as a Tesla Model 3, or even high-end professional equipment like cameras, computers, or office machinery. At first glance, these purchases seem expensive and immediately daunting because of their sticker price. But when leveraged correctly through business structures and tax rules, these same purchases become powerful financial tools. In the United States, for example, if you purchase a vehicle for business use, you are allowed to deduct not just the depreciation of the vehicle over time, but also related expenses such as registration, licensing, insurance, and even maintenance, all of which reduce your taxable income. Similarly, in Canada, vehicles, equipment, and professional tools are treated as capital assets that can be written off under specific ACC. Accelerated depreciation rules, allowing business owners to reduce their taxable income in the very year they make the purchase. High-income earners in the UK utilize similar strategies with business cars and equipment, leveraging capital allowances to offset profits legally. The key insight here is that what looks like a cost on the surface is actually a tax optimization opportunity when properly structured. And this principle applies to virtually every high-ticket purchase made by financially intelligent individuals in high RPM economies. Let's break this down further with a practical example. Suppose you are considering purchasing a $50,000 electric vehicle for your business. In most high RPM regions, government incentives, such as the federal EV tax credit in the US, provincial incentives. In Canada, or energy-efficient vehicle programs in the UK and Australia, reduce the effective cost by several $1,000s. For instance, in the United States, the federal EV tax credit might be $7,500, which directly reduces your tax liability dollar for dollar. Combine that with business deductions for depreciation, interest if financed, and operating costs, like insurance, and you're effective. Monthly cost could be reduced to a fraction of the original payment. High-income earners intentionally use these rules to their advantage every single year. They don't just buy assets, they structure every purchase to maximize tax efficiency, cash flow, and long-term wealth accumulation. In other words, every asset purchased strategically through a business entity or as part of an investment plan has the dual benefit of providing utility and reducing taxes simultaneously, a concept most salaried employees never consider because they view high-cost purchases purely as consumption, not strategic financial moves. Another layer of strategy is financing and leveraging debt to increase efficiency. While most people are conditioned to avoid debt, high-income earners know how to use financing as a tool to both preserve liquidity and maximize deductions. For example, if you finance a $50,000 vehicle at a reasonable interest rate, the interest payments themselves are deductible when the asset is used for business purposes. This means you're not only preserving cash flow to invest elsewhere, but also legally reducing taxable income at the same time. Combine that with accelerated depreciation. Parading expense write-offs and government incentives, and suddenly what appears to be a $50,000 cost could effectively become a monthly investment of a few $100s or less, all while maintaining the full utility of the asset and leveraging it to grow your business or professional brand. In countries like Canada, the UK, and Australia, similar financing and write-off structures exist, all owing savvy individuals to purchase property, vehicles, or professional equipment without crippling their cash flow while simultaneously maximizing tax efficiency. Now, let's connect this to the mindset that separates financially intelligent individuals from average earners. Most people see a $50,000 car or a $20,000 professional tool and immediately think of it as an expense, something that reduce their wealth. But in reality, when structured correctly, these purchases are strategic assets that generate both tangible benefits and financial efficiency. High-income earners understand the multiplier effect. Every dollar spent strategically is tax-optimized, leveraged, and positioned to create compounding financial value over time. Whether it's a Tesla, a high-end camera for content creation, or an essential piece of business equipment, the math is simple. Deduct what you can legally, leverage debt smartly, time your expenses strategically, and combine it with tax credits. The effective cost is far lower than the sticker price, often shockingly so, which is why wealthy individuals in high RPM economies rarely pay the full upfront price of high-cost assets in real terms. They pay far less thanks to smart planning and structured financial strategy. Finally, I want to emphasize one crucial factor that keeps this strategy working year after year: documentation and professional guidance. High-income earners in the US, Canada, the UK, and Australia meticulously document every deductible expense, depreciation schedule, and incentive claim. They work with CPAs, financial advisors, or tax professionals who understand these systems in depth. This level of discipline is what separates them from those who simply overpay taxes because they are unaware of available deductions and incentives. By maintaining accurate records, planning purchases strategically, and leveraging professional guidance, you can legally reduce your tax burden while building significant wealth over time, all without ever engaging in illegal activity. And remember, this is exactly why a channel like this exists, to give you access to this high-level financial strategy in plain language, so you can start applying it immediately and see measurable results in your own finances. As we wrap up this discussion, it's critical to understand that the strategies I've shared today are not isolated tactics. They are part of a comprehensive financial framework used by high-income earners across the United States, Canada, the United Kingdom, and Australia to legally maximize their wealth and minimize taxes year after year. This framework combines structured business income strategy, see high-cost asset purchases, depreciation, tax credits, smart financing, retirement contributions, and precise timing of income and expenses into a cohesive financial plan that continuously compounds over time. The secret to success in high RPM economies is intentionality. Every dollar you earn, spend, invest, or borrow must be considered through the lens of efficiency, tax optimization, and long-term wealth creation. For example, consider the process of purchasing a business vehicle like a Tesla or other professional equipment. While many people see this purely as a one-time expense, a financially literate individual sees it as an opportunity to generate deductions, leverage tax incentives, maintain liquidity, and invest in long-term value simultaneously. By applying this mindset across all high-cost decisions, you transform your financial life from reactive to strategic, allowing you to retain more of your hard-earned money, invest it wisely, and watch compounding growth accelerate in ways that ordinary earners could only dream of. Let's examine the broader picture with a simple principle. Taxes are not just a cost, they are a tool. In high RPM NTIRIs, governments intentionally create incentives that reward the behaviors they want to encourage, starting businesses, investing in assets, creating jobs, and contributing to economic growth. Understanding this framework is what separates financially intelligent individuals from the majority, who simply work harder but pay more in taxes. For example, a high-income earner in the United States, WHO, properly structures their business, claims depreciation on a vehicle, applies all eligible tax credits, and maximizes retirement contributions, can reduce their effective tax rate by tens of thousands of dollars annually. In Canada, similar principles allow incorporated professionals and small business owners to legally retain a far greater portion of their income, while in the UK and Australia. Strategic use of capital allowances, superannuation contributions, and enterprise investment schemes achieves the same outcome. These strategies are fully legal, fully transparent, and fully scalable, meaning they work for small businesses, side hustlers, and large corporations alike. The difference is discipline, awareness, and consistent application. One of the most important lessons here is timing, planning, and professional advice are just as important as the strategies themselves. High RPM earners never leave deductions, credits, or investment opportunities on the table. They meticulously plan their purchases, their financing decisions, their charitable contributions, and their investment allocations to coincide with the periods that maximize tax efficiency. For instance, if you anticipate earning more next year, you may defer certain expenses to the following fiscal year, or accelerate deductible expenditures to the current year. Similarly, timing asset purchases or investment contributions to align with available tax credits can dramatically reduce the effective cost. In countries like the United States, these strategies can reduce annual tax bills by tens of thousands of dollars, and when combined with long-term compounding, the financial impact is exponential. The same principles apply in Canada, the UK, and Australia, where careful planning around depreciation, superannuation, capital allowances, and tax credits transforms what seems like high costs into effective, optimized investments in your future. Now, I want to leave you with the ultimate mindset shift that separates financially successful individuals from those who struggle despite earning similar incomes. Every expense and every financial decision is an opportunity for optimization. A car isn't just transportation, it's a deductible asset. A home office isn't just a space, it's a tax advantage. Retirement contributions aren't just savings, they are strategic tools for reducing current tax exposure while growing wealth. Investments aren't just money in the market, they are vehicles for long-term compounding with favorable tax treatment. Once you internalize this framework and consistently apply it, you begin to see opportunities everywhere that were previously invisible to you. The result is more retained income, accelerated wealth growth, and an optimized lifestyle, all fully legal and full. Ethical. This is the blueprint used by the top earners in high RPM countries, and the beautiful part is that anyone who applies it correctly can achieve the same results over time. Finally, I want to encourage you to take action today. Knowledge without implementation is wasted potential. Review your current financial situation. Consider how your income is structured. Identify all potential debt. Deductions. Explore applicable tax credits. Plan high-cost purchases strategically. Leverage financing where appropriate, and maximize contributions to retirement accounts and other tax advantage vehicles.